Hey everybody, hey traders, Chris Pulver here, just after 3 p.m. on Monday the 29th. We have another holiday disrupted trading week, and I've just been thinking big picture for 2026. Basically, I just built this on ChatGPT, and this kind of summarizes where I'm at for the year of 2026, which is I listen to a lot of interesting podcasts, newsletters, subscribe to a lot of smart people out there. Um, I've got my own opinion, of course, but it's nice to have some data to drive my decision making and probabilities. And I'm literally seeing forecasts of a 20 to 40% correction in the markets to the downside and a 20 to 30% upside push. And the bubble keeps growing, and we're not in a bubble officially. So the markets can keep going. This is still cheap relatively. Or relative to where earnings can be, even though we're in like the 1 percentile of all time earnings, according to like Cape Shiller and things like that. So that's a very wide distribution of where outcomes could park, and obviously we'll navigate everything to the best of our ability. Perfect world, I would say I'd love a correction. I'd love a 10% correction, 15% correction that the market gets really nervous about, and yet it's just like a lot of other corrections we've seen the last decade plus, which have been V bottoms, and the market finds a way to find good structure. 10 to 15% is a quick deleveraging story, and then the market picks right back up where it left off, and there's backstopping and liquidity additions, and the narrative shifts, and the story changes, right? So anyway, it's going to be an interesting year for 2026. I will say that I think that's the easiest thing, but I am not getting overly committed to anything. I did start to sprinkle in some positions. Basically, I'm looking at some weekly trades and some monthly trades, and then if I get a better feel for the markets going, I'm going to use some of my favorite strategies to be flexible and also customize my trade size to get in where I think the market is going to offer me the most reward to risk, or just good levels that I can kind of stack up over a period of time using some options and get some nice income trades stacked up over X amount of months. So I would say optimistically, if the market is going to give us let's say less volatility, or like steady sideways, steady up for maybe the first 6 to 8 months of 2026, I could certainly see that. It's hard for me to build a true bear case right now. I know that I'm on the graphic right now. Just stay with me. To build a a true bear case after this market has climbed years and years of the wall of worry. Um, I can't really see a bear case that's going to fundamentally change where we are at. Yes, we have a regime shift in the Fed. Yes, we have somebody that's still going to pay attention to inflation, although it sounds like it's going to be a stooge for Donald Trump. But the reality is, you know, Donald Trump wants to see the stock markets at all-time highs. In order to get that, we need to see inflation somewhat under control. That is still on the Fed mandate. We also want to see the labor market not deteriorate any further, and see if we can still have like reasonably tight unemployment. The gig economy remains strong. And I just think like a lot of the data we are digesting right now after a government shutdown is being questioned, right? We had a big print in CPI that printed at 2.7, which was like a 3 to 4 tenths of 1% drop. And the market took it in stride, and went up from it. We got into holidays. We hit all-time highs last week over Christmas, up to 69.45. We pulled back a little bit, but we do have some decent flows that I'll be watching this week to see if we get back to those highs at 69.40, 69.45, maybe even by Wednesday, which is the end of the year's trading on December 31st, or New Year's Day when the market is closed, or January 2nd. Maybe some flows up into the high 6900s, maybe 6950, 6975, even 7000. That would make for a nice little milestone, either end of this year or very early January, to start hitting some 7,000 plus, and have that be a nice check mark, round number, kind of pin price in the S&P for 2025. And that gets us up very close to a full 20% gain, which would be 3 years in a row. So could the market stay steady to the upside? Sure. I think that in order for us to see, if you want a bull market that is going to give us 10, 15, 20% upside, I think you have to expect the market to give us a 20% pullback. I'll say that again. If you want the market to give us 15 to 20% upside, I think you have to expect at least a 10, 15, 20% correction in order to get that. That is the reflexive nature of the markets. So scare the pants off of everybody, and then we find a dip, look for some really good technical alignments. I think anything that stays above 6,000 is pretty firm to still maintain bullish support. I think a pullback as deep as maybe 5,500 would still offer a really strong support level in the S&P to still push this market higher to revisit all-time highs. But I don't think that we just go month by month by month up 15, 20% for the year. If we do, that's going to be a lot like 2017, which was a very surprising but super low volatility year. And that ended with some volatility events in early 2018. And then we had volatility events in 2018 and 2019 and 2020, and again in 2022 and again in 2025. Big volatility events, in fact. And don't discount summer 2024 either. So it's almost more challenging to see the market drift higher slowly but surely, even though that's great for most investors. Just keep parking in money, adding to leverage, thinking that nothing could go wrong. This is a super stable market. Eventually, if structure breaks, it doesn't take much to take away a lot of gains. Um, I've got some examples to show, but imagine the market's up 20%, and in one kind of floor that breaks, we could be down 5 to 10% and just kind of put everyone on their heels. And then we're all backpedaling to wonder and scramble. Is this going to be a bull market? Is this the top? Is this the fourth turning? Is this the end of times? Blah, blah, blah. Right? It's like, it's very extreme. So indecision for 2026. I am not going to take heavy positions. I'm sitting around 60% cash. I'm giving myself plenty of time, plenty of margin for error. I'm just going to dip my toe in the water for a lot of my trades right now. And I will start off with a clean slate. What I accomplished in 2025 doesn't matter anymore. It is a clean slate, ready for a new trading year. Let's find some good trades. So, all right, I'll park this for right now. What I'm looking at right here is my Tanuki Trade Live feed. This is getting us some gamma feeds. We did have a dip and a pullback today. So going into today's trading for 0 DTE, we are looking at, so we had a gap lower. I established a little bonus trade today for daily profit play. Any follower that was in my live session this morning got it. We are looking to kind of pin a 6,900 level. If price stays here for the week, if we close around 6,900, 6,903, we're actually going to get a big fat profit trap. If because this is a holiday, the market is back up to, fill this gap. Let's say the market can go up to, let's say the close around 6,930 or so. That would give us a pretty good confirmation that, having some disrupted trading on Thursday with the markets being closed, Friday, just another day at the office type thing. Markets ready to kind of get back into full swing on the 5th or the 12th. Might be a light week next week. We'll see what kind of data we have rolling in on the calendar. But if we're back to 69.30 or making our way back up to fresh all-time highs around 69.45, then our bonus trades will look pretty good. We got a couple of dollars of bonus profit there. If we're hanging out around 6,900, that's fine too. I want to see, one thing we are doing right now is we're right back into this positive and negative gamma pivot, which is around 69.10 for today. If I go into my live feed here, I'm looking at more like, let's see what New Year's Eve looks like. So this is a 2-day expiration. So out to Wednesday, we're trading at 69.11 right now live. You can still see that I have some positive gamma flowing up to about 69.50, which is my largest level right now. We did have a significant pin price around 7,000 that I did look at last week. 69.50 was on the radar. We hit 69.45. I had some good profits on some holiday trades the last couple of weeks, and it was all kind of running up towards that 69.50 target, which we hit 69.45 to that. I say good enough. But 69.50, a pretty good gamma level. Let's see if we can make some flows up there this week and refill that gap around 69.30, get to 69.50. Do we flow higher than that to try to get up above 69.50? If we get above, there's not really much to stop it outside of maybe a 7,000 pin price. And that's a JP Morgan collar trade. That's a big level where there's going to be some dealers and hedges that will kind of run up to that to hedge the long side, and also most likely act as resistance in the near term. So I would say if we can stay above, let's say 6,900 this week, flows up to 69.50, breaking some all-time highs again, flows up to maybe 7,000, and then I would say the market probably stumbles or stalls again at 7,000. Okay, we go out to Friday because we have to skip Thursday because of New Year's Day. Friday, we still see positive gamma. Again, biggest strikes around 69.50. Again, a larger strike at 7,000. So I think that's a big spot. If the bulls can overcome 69.50 and drift higher, I think from 69.50 up into that 7,000 handle by Friday is pretty achievable. You go out to next week, and these are where my expirations are for some of my bonus trades. Looks very similar. We have a bit of a contested run between the 69.50 and 7,000. Again, these levels to me are pretty darn important. Okay, so as long as we stay in positive gamma this week, as long as we're above 6,900, I'm looking for flows to continue to make some fresh highs. Technically, we are in the Santa rally window. So Christmas Eve to New Year's Day is the Santa rally. I looked at that here where we started Christmas Eve. This would be right in here. This was the 23rd, and then limited trading on the 24th. So Christmas Eve, I know the market kind of had this technical run up around like the 19th to the 22nd. So the holiday type mood kind of started in the markets on the 22nd with this gap higher. So from the 22nd up, we had a nice little holiday rally. But technically, the textbook Santa rally is the 24th to the 31st. So we started right in here after a nice little pullback on the 23rd. Here's our 24th trading, limited trading days or trading time the week of Christmas, but we're right back where we started. So if we can get above, let's say around 69.10, then we're getting a positive Santa rally, which last year the Santa rally was negative, and 2023 the Santa rally was negative. So could we have a positive December and a positive Santa rally? If so, we'd have to stay above 69.10 to do that, but that would be a good sign. Do we hit some fresh all-time highs? Let's find out. So that's where we're at right now in the S&P. Let's go big picture here. So big picture, I still have this broadening pattern. I talked about some of the technicals earlier. Where do I see some really strong support? I see some really strong support. I'll just draw this on the charts here. Where is my brush tool? Here. Some really key levels. Can I go? Yep. So key levels, October 10th and November 20th. These two candles, let me zoom in. So this October 10th sell-off, this November 20th sell-off, that to me is a strong technical level of support. As long as the market stays above that, the bulls are still in control. If we break that level, let's just take a high to low swing, measure that move, and that's going to put us right back around the 6,100 handle. We did hit all-time high, so this is going to be a slight difference in measuring, but let me measure this out. So let's go from recent all-time highs down to the low, and then double that move. So I'm going to copy and paste this, double that move right there from the measured breakout. That should put us right around, that's an overlap. I'm trying to get rid of that overlap. There we go. Okay, so within probably plus or minus 5 or 10 points here, that puts us around 61.20, and our previous all-time highs around 61.45. So to the downside, some early forgiveness that I'm trading is as long as the bulls can maintain some interest in propping this market up and keeping it supported above 6,500 and above 6150, I maintain a bullish outlook on the market. Now that does give us some forgiveness, right? I mean, the market doesn't have to just keep marching higher. In fact, that's probably going to be the more challenging trade, is just going higher, 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 because I do think that probably ends with a pullback to past resistance or a nastier pullback that might, again, put everyone on their heels, get really ugly. I just don't know what the narrative is, right? Trump in this last year for 2025, he led with tariffs, he led with immigration policies. The market didn't like it, and it let us know. The market hated it in March and April, and then the market priced in negative stuff, and we flipped and did a complete 180 on policy, and went from cutting and balancing and Doge and all that stuff to let's grow, baby, grow, and trade with everybody and do the deal. Let's do the art of the deal. And here we are at all-time highs. So I think whatever type of pullbacks we get, as long as there are aggressive kind of dip buyers around those key levels, I think the market maintains a bullish posture. The challenging trade, like I said, is we go higher, 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 very, very slow, very steady. I wouldn't call the top, okay? But what I would be looking for is if that structure breaks, let's say we go higher and higher and higher, I would just be looking for some type of trend line and maybe some type of rising wedge pattern, that if that rising wedge breaks, so let's say the market does this and this and this and kind of climbs up here. Well, there's two ways this plays out. One is we roll over and we break structure and we give it all back, and that's still a strong support level, okay? Or what rising wedges can also do is they can fail if the market breaks and goes higher and it doesn't immediately reverse. This thing is going to go even further to the upside, and you just measure what this is crazy, man. If we go from this measured move and what got us into this kind of wedge look, measure that, measure a breakout, and we're probably talking like a 75, 7,600 S&P. Okay. So I'll be paying attention, obviously, to the technicals. But I just want to make sure that from the start of the year, I'm not getting overly committed to anything. right? I think that a little 5 to 6% sideways is fine and healthy. I think that market breadth is improved quite a bit the last 30 or 45 days. But we want to continue to see solid earnings for the market. We want to continue to see that the narrative is pro growth. We want to see that the Fed is not overly reactive, but rather they are doing some mild QE right now. They are kind of supporting the fiscal dominance that's in the markets at this time, and that continues to be, I think, a tailwind for the markets to go higher. Do we need a deleveraging in the tech side? Possibly. We have the Mag 7 still concentrated, like 40+% of all S&P is basically within 10 stocks. If you look at Mags, this is one thing that will have a big pull on the markets. So if we have a correction in Mags, it's going to drag the S&P and the Nasdaq lower. If we see more grinding to the upside in Mags, that is just money flowing to the top again. We get more and more concentrated. I don't love that at all, but equal weight. Okay, we had a nice little comeback trade on equal weight after that November. This was kind of the big disconnect is equal weight almost outperformed the large cap market weight. So this would be RSP versus SPY. We almost had an outperformance here when the market was down up around 7.3%. Then you go to your SPX and you take that same low. That same low is around 6.4%. So the equal weight actually outperformed. If you take a look at the this is one thing I use for market breadth. This is how many stocks in the S&P are above the 50-day moving average. It is now a healthy 62+%, and how many stocks in the S&P above the 200-day moving average, a healthy 60%. So as far as this, no stocks are participating, it's Mag 7 or it's top 10 versus the world or versus 490. Well, I mean, we still have a majority of stocks showing that they're in a bull market. Technically, they're a bull market. So that's a good sign. As long as we stay in the majority where prices, especially on the 50-day moving average, if a majority of these stocks are above the 50-day, I think we still have more upside as the market kind of rotates and money goes in, money stays in, and money continues to benefit from more flows, more liquidity, and putting money to work in the markets. Could there be a rotation into other sectors? Of course. Do I think that the market's going to be led this year by Mag 7? Probably not. Do I think the market's going to be led by AI? Probably not. I don't love the fact that AI-based stocks are like the circular web of who is creating things to pay for things to then borrow things to then sell things. The web of like 10 companies that are all in this AI trade together. I don't love that. To me, that's really that's a story that you have to latch onto and be all in on, and I'm not. Plus, I don't want that type of volatility. I think that one of the big things for 2026 and 2027 is the AI narrative is that we don't necessarily have a true front runner. We have a bunch of companies that are viciously competing to be number one. And I think that it takes away some of the competitive advantage of NVIDIA. It takes away some of the clout from an Apple or even a Microsoft or a Google, which are obviously great companies and they have a ton of cash. But when you are raising debt in order to cover data center build outs and cover your AI spending and your CapEx, that to me, it's not like 90s bubble. It's not .com bubble, but why raise debt? Like debt is more expensive. I know they have lots and lots of cash, but still cash isn't enough. It's so they need more. And I just feel like what's going to happen is they're going to stall growth because of the overspend. And who benefits? Probably the smaller competitor that you could be pretty lean and mean right now and actually take advantage of AI, but also make things, produce things with way less workforce, or just be a middleman somewhere, be part of the physical side of AI, which is building out data centers, building out the grid, trying to hopefully have some better energy optimism energy optimization. So it's weird. Like we are in like this all in. It's a national security thing. We've got to be all in on AI. I think we're doing it kind of backwards. I think that China has spent years and years and years building out the infrastructure to then layer in what they want to scale. I think what we are doing is we are now just throwing money at the problem and trying to quickly catch up. Which again, I wouldn't say that the U.S. is wrong. I think that at least making this an issue and being all in and have this be supported from the government as well as every major company publicly traded, that you're either going to be a part of this AI shift and hopefully big innovation, or you're going to get left behind. What I don't want to be is I don't want to be in a stock that I think is great for the next, 3 to 5 years, when I wouldn't trade anything more than like 6 to 12 months out right now. There's not a lot of stocks that I would say I want to look at long term positions on for more than maybe 6 to 12 months. And if I'm going out 6 to 12 months, I'm going out with a ton of margin for error. So here's an example. I just took a trade today on Tesla. I am putting on positions on Tesla that have a December 2026 and a January 2027 expiration. And the strikes in which I would be assigned would be all the way down to 205 or 200. So I'm giving myself on Tesla, I'm giving this from recent highs. Tesla could drop over about 60%. So we could be, I mean, if it's down 60%, I still have some assignment that I would then repair my trade. Yes, there's risk if it drops, but my real threat is if price is going to be down over 60%, then I'm going to repair Tesla. Otherwise, I think that this technically looks great. I think Tesla, if we keep getting dips and dips and dips and dips, we just keep watching this thing go higher. This could be a really interesting story and great story for 2026 with the build out of robotics and autonomous vehicles. And if it's accepted and going, citywide, state by state, and this is just in the U.S., but if Tesla can get a foothold in other parts of the world, and we can start seeing an increase in fleets or seeing something like dedicated specifically to autonomous vehicles, that would be pretty impressive. And I think that's going to be a huge tailwind for Tesla. So, I'm putting in trades that it's like, I think it's high probability. If price goes up, I get paid on those trades. If price goes down, I'll give myself plenty of room to then, figure out technically where else I want to position and add to it. So my core position is sell some puts, create some ratio spreads that are 60% off. And that's my room for error. Okay. I did the same thing on the SPY, where I'm using the lows from April. And if I were to take any ownership on the SPY, I would basically own it at like 485 or 480, which off of these recent all-time highs would be ownership of the SPY, and the market could drop about 30%. Do I want the market to drop 30%? Of course I don't. Okay. Nobody does, because it's never going to be fun to navigate. But if it does, for whatever reason, if it drops 30%, does it happen in one straight line? Probably not. So if we roll over, I look at something like this, and let's say that this is the top, right? Let's say the doomsdayers, they're all right, and it all comes to fruition, and the market is down, 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 down. Connect the dot, connect the dot. We break these lows. I think that this trap is a bear trap down here below like the 460, 450 handle. This would be on the SPY. And then we go right back up the trade into the chop zone. Could I flip the SPY for, let's say a 450 break even, and then get out of the trade around like 570 to 580 and make, $100+ a share? I think that's very possible. Could I, commit myself to holding it all the way back to all-time highs again? That's very possible. So the good part is I'd be starting at a massive 34% discount from recent all-time highs. And I think that gives me plenty of room for error, like plenty of margin for error to then repair, turn it into an income trade, put in some more positions I can hold and be happy as kind of investing in a 30+% discount, and then give it some time to work itself into a nice profit. Okay. All right. So, big picture, a lot of indecision, which I don't love. If I could come into this video and say, hey, I know exactly where the S&P is going to go, I know exactly where the Nasdaq's going to be, I know what stocks are going to be the best picks for 2026, then I trade it. But I don't. All I know is that it's been a good year in 2025. I will do what works best. I will do what made me, profit safely. Could I have made more money in 2025? I'm sure everyone can say yes. Could I have managed risk better in certain trades? Yes. But at the end of the day, I'm happy. I've got accounts that have done very well this year, and very steady and stable. I didn't take on a lot of risk. I mean, when the market was down 20%, I was still down single digits, which that's probably my highlight of the year, which is just not getting absolutely crushed and having the fear of like dumping all my positions, when the reality was the VIX is up to 30, 40, 50 plus. I'm going to sell some premium. And I've literally, I've been riding this fall since February, March, and April. I've been selling premium and riding call or riding up positions that have been staggered out with expirations and options all the way to the end of the year. So November, December, even into the middle and end of January, I have trades that are still offering me profit into the next 30 to 45 days, which I expect those to still offer me full profit. Should I protect them early? No. I can, of course, but considering my break-even prices are all the way back down to these April lows, I'm really not that concerned about what the market does up here, other than maybe chop around. So if we have the same type of situation like we had end of the year in 2024, the market took until, February to start rolling over. So if we have, up, 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 great. We hit 7,000 plus, exciting. If we roll over, we're going to look for some type of topping pattern. So perhaps, let's say the market goes up and then we have a nasty spill. Well, we could have a follow through there. There could be a healthy correction. Look left on your chart. There's good technical support in here. Wait for a trend line to break, and then we start positioning for more upside. I think if you are if you're an investor looking for an opportunity to buy some dips, that'd be a great spot. Is let the market give us some type of technical correction. Either wait for confirmation on the right hand side of that trend line, or look left and find some resistance become support. If you want to kind of call that bottom, those are some good areas that I'd be watching. If you're big picture long term, then you don't care about any of this stuff. If you're big picture long term, you just want to keep dollar cost averaging in, staying in the markets, and something that's going to go higher over the long run. We probably hit 10,000 in the next decade on the S&P. Awesome, right? So what does that mean from here? There's another 30% upside. So who cares if the market has a 10, 15, 20% correction if we're just going to get to all-time highs, right? But that's big picture. I'm not big picture. I want to trade for the next month, the next 3 months, the next 6 months, 12 months. That's how I'm positioning my portfolios. And that's why I take, 20,000 trades a year, 30,000 trades a year, because I will take little tiny base hits and do the best I can to manage risk. So even when the market is down, I'm down a minimal amount. When the market is up, I'm getting, hopefully as much of that upside as I can, and hopefully outperforming the markets. All right. What else we want to talk about? Let's go dollar index. The big themes for 2026, dollar index. We've had a decent pullback. We're back below the 100 handle. Could we fall back down to some fresh lows on the dollar? Sure. Am I super bearish on the dollar? Not really. But does that mean I want to buy it? No. I think currency is the one basket you probably want to follow the most is going to be anything yen related. Okay. We're getting a nice little chop zone here in the dollar yen. 2026 might end up hitting some massive intervention. Just keep an eye on this. I mean, here is an Aussie yen chart. If we start to see some BOJ intervention, it might be right up here in Aussie yen around the 109, 110 handle. Man, that could be a fantastic low risk, high reward setup. Doesn't mean it's a great trade because who knows what the Bank of Japan is going to do. But if we had a position to, sell high and let this thing run back down for a range, even that trade with a stop loss, I mean, you're probably talking like a 5-to-1, 6-to-1 opportunity in just the big picture, which, you can't ask for a better setup. I don't know if that's going to be a winning trade. There's so much craziness that happens at the central bank level, especially with the Bank of Japan. I'm just going to keep an eye on the overall basket. So that's CAD yen, or that's Aussie yen. Here's CAD yen, same type of thing. Could we come up here and find, beautiful resistance around this 118, 119, technically look for a topping pattern and then dump it all the way back down to 102? Low risk, super high reward. Could be a great trade, but the basket has to follow through. And I will say this sell-off in strength in the yen that was caused, I mean, you can see this entire swing in 2024. If this happens in 2026, remember, this was a 10 to 20% sell-off in equities. The S&P 500 was down over 10% in July, August of 2024 because of a deleveraging or a Bank of Japan, carry trade unraveling. So it does have a spillover into the equities. Now, the Nikkei was down like 25+% in a 2 or 3 week stretch, like one of the worst sell-offs we've ever seen in the Nikkei. And that was over a matter of a couple of weeks with the same thing. So it is not nothing. I think that you do have to pay attention to the yen crosses. Here's the Swiss yen. Technically, we're at all-time highs. We've never had this high before in the Swiss yen. It doesn't matter. It doesn't mean I'm calling the top. If we get a technical pattern, I will take the swing trade. If we break structure, we get on the right side of the trend line, I'm going to take a stab at this and see if we can unravel. I mean, man, this would be just an amazing trade, right? Let's say we break, we get a sell trade around like 194, 195, stop up maybe 400 to 500 pips, trade small so you can accommodate that risk, and then let this thing come all the way back down to 180, maybe come down to these lows at 166. I mean, just massive reward opportunities, but I want to see that either one, the Swiss is very weak, or two, the yen is very strong. And I don't know if we're there yet. Same thing here on the euro yen. Overbought conditions on the daily chart, a nice little trend line break. I want to see some clean structure. We don't have it yet. Pound yen, all the way back up to fresh highs. Again, do I have any structure to sell this? No, I don't. I'm not forcing this. I'm not buying this. I'm just hanging out. Here is New Zealand yen. Still some more room to keep climbing to the upside if we're going to have the same type of structure. This also might be low to high, higher low to higher high, come back to the same area right around this like 92 to 93 handle. If it tops out here, maybe it falls back down. If it gets above here, we're eating into this inefficiency. We could just be continuing to go up, up, up to 98, 99. Dollar yen 156. Lots of chopping here, looking to see if we can get back to. I mean, we have highs at 159, highs at 160 and 162. Those are big levels on the yen crosses for the dollar yen. Okay, other currencies, Aussie CAD, I'm still long. Aussie, New Zealand, I am still trying to hold this thing short with a stop loss above these highs. Aussie Swiss, we had some promise. It's just not making high. I want to see if this is a low, high, higher, low, higher, high. I'm looking for a symmetry trade out to like 5,600 or so. And then I also want to look at a 5-wave move. So this would be wave 1, pullback. I'm looking for a push to wave 3, and then a 4 and 5. Maybe my long-term target's like 57 to 5,800. CAD Swiss, looks a little bit more encouraging. This has been in a crazy multi-year downtrend. If we put in a bottom, I'm looking for a 3 to 5 wave move to close this thing out for some profit. Swiss yen, nothing. Euro Swiss holding nicely at 92. I want to see this get back to like 96 or 97. I'd love to see this get back to parity at 100. I've been holding the Swiss yen for over 2 years. Or I'm sorry, the Euro Swiss for over 2 years, just generating about a 3 to 3.5% swap. And I'm hoping that price wise, I can get some appreciation and pips to go with it. So my target would be at least getting back to 96.50. My destination, as far as taking profit and clearing my entire position that I've been building for a couple of years, would be at the 99 or the 100 handle. Pound Swiss, I'm holding this long since about 107, and I scaled into 105. So 107, 105 long. I'd like to see if we can get back into 112 or 113. New Zealand Swiss, somewhat of a bottom here, just not super convinced that this is the low. If we go low to high, higher low to higher high, okay, fine. Give me a 5th wave. Now we're talking back into like maybe 4,900, maybe 5,000. I'd be taking some profit in there. My dollar cost averaging has got me a break even around like 4,700. And then dollar Swiss, testing some lows. We're on the right-hand side of the trend line here. I could see, even if it's a nasty spill to the downside, I'm looking for a bottom to emerge and then see if this is going to switch. Now, I don't know if it's dollar driven or if it's going to be Swiss driven. Technically, I'd love to see the Swiss get hit pretty hard. I mean, gold's been a great trade in 2025. Silver's been a great trade in 2025. Platinum's been, precious metals, industrials, they've been doing great. Commodities have come back in a big way. I mean, I even have an aluminum trade in a stock. So Alcoa is aluminum, and CLF and X is Cleveland Cliffs. They make steel. Those like real asset trades and those precious metals, those industrial metals have been doing pretty darn well. And they've kind of been flying under the radar because everyone pays attention to AI and pays attention to tech, when in reality, there's definitely some heavy rotations going on. And gold and silver has made for a crazy, crazy story in 2026. Anyway, dollar Swiss, I'm looking for a bottom, see if I can get some structure in and some type of measure move. So that covers my dollar. That covers my yen basket. That covers my Swiss basket. Some other currency pairs I'll sprinkle in when I find them. But for the most part, I'm holding a couple positions. I'm Aussie, New Zealand short. I'm Aussie CAD long. I'm New Zealand CAD long. I've got some robots running as well for some Forex trades for me. Sector-wise, it's a clean slate for 2026. I don't know who's going to win. It's kind of easy and status quo to think like that Mag 7 will still be strong and resilient. I think that you must have a positive AI story. Must. If the AI capex becomes a problem, if the forecasted revenues, if the expectations, if the optimism changes, I think that is a quick move for the markets to rotate out of tech, rotate into other stuff, maybe be a bit more defensive, and maybe even good old boring bonds start showing some bid this year. Bonds have been pretty darn stable. If you go to, this is TLT and this is also ZB for bond futures, extremely stable, super low volatility. I want to go to the year. Let's go 12-month candle. Bonds for the year, I believe, finally broke. I mean, barely. This is embarrassing. But if you go to the 12-month candle here for bond futures, we are technically a positive year for bonds. They opened. Here's an open at 113. We're trading at 115. So percentage-wise, minimal gains for the year, but with the yield, which is up to the high 3s right now. This is bond futures, so you'd have to look at TLT for the dividend, but you're probably looking at like a 3 to 3.5% yield. You take that on top of a positive, 2%. Hey, that's not a bad thing for risk-free, but I'm putting that in quotes because obviously the market's been down for 4 straight years. So you can't tell me that bonds is risk-free, right? You go to the 12-month candle in TLT, and what do we have? It is dead flat. Like it's a sliver of green. There's the yield I was talking about, 3.81%. So if you've essentially made, a fraction of a percent, but also maintain a decent yield at 3.5 to 4%, there's your risk-free rate where if you're worried about anything, you can park it in bonds. There's your little safe haven play for 4 to 5% for the year. Is that what I want to do? Not really. In fact, if I'm going to go risk-free for 4%, I'd rather do a box spread in the S&P. And I've talked about this before in some live sessions, but this is a trade that is this is a guaranteed profit. And you would never hear me say that, but it is true. You can build out an SPX trade. You have to go out about a year or so to get the percentage that you want, but I'll show you what it is. If I went to January 2027, which is just out over a year. So I'll go SPX January. And if I do, we're trading around 6,900. If I go 68 by 7,000 and 7,000 by 68, this trade is a $192 debit. So it's going to cost me, buy power wise, it's going to cost me like $19,000. Okay. Now, if I did this I'm just throwing this out there. Let's say that I'm risk free. I don't want any risk in the markets. What do I want to do to make about 4%? Well, I will show you. If I parked $100,000 in this trade, that would be what, 19,000. So I'd have to park about 5 contracts in there, right? 19,000 times 5. So I'd park $95,000 in cash, and that would be 2, 3, 4, 5. Okay. So if I paid 192 on this, that gives me, the trade is guaranteed to close at a $200 credit. So $200 credit minus the debit of 192 makes me $8. Okay. $8 times 500, because it's 5 contracts. So it's representing like 500 shares. I get $4,000. That is a 4% yield. That is risk-free. I would rather do that than put money in bonds. That's how cautious I am of parking money in, safe haven. If you want to go to a bank, a Goldman Sachs, a JP Morgan, a too big to fail, and buy a CD or money market and park some cash that's risk-free, I would take that over parking it in U.S. Treasuries. Just saying. So you can do this in an equities market. You can do this in an options market. This is risk-free. You can go obviously, tie up and make it illiquid in a bank for a certificate of deposit or money market as well. But in the stock market, this will actually benefit over time. So if I want to pull half this profit out by, June or July and get the liquidity back, I can. This trade will just like slowly work its way towards full profit by expiration out to January 2027. So I wish it was offering more. I wish this trade was, down to 190. If I could make, I guess that'd be what? If I could make 10, so versus 8, if I made, basically 5, it'd be 5%. So could I go 5% risk-free? Well, it's not there yet. So if I did, anyway, between 190, 191, 192 debit, this is a pretty safe way to park up some cash. Do I want to do this? Not really. There's better ways to deploy my capital, and I've been, raising cash pretty aggressively since probably the late stages of 2025. When this market is creeping up the highs and I'm getting that melt up that's benefiting from a lot of those trades I took back in February, March, and April. So, all right. So again, this video is, for everyone that follows me, what's kind of my end of the year? Where are we at? Well, we're sitting near all-time highs. Do I think we can flow into some positive levels? Sure. I could see, positive gamma going into the end of this week. I could see positive gamma getting us into officially the end of the year. Whether it's, Friday the 2nd or Monday the 5th, I think that getting back above 69.10, 69.20, we can start flowing back to 69.50, maybe even, if we're really lucky, getting back up to like 7,000 with a nice little positive holiday rally again this week. If we hit that awesome, great milestone, 7,000, who'd thunk it, right? Especially after the 20+% correction, and then a 40+% reflexive rally. But that is probably what I would expect to see moving forward, is if you want 20% gains, you're going to have to deal with 15, 20+% pullbacks. Okay. So just be ready for some volatility in 2026. I think that it's crazy to me that I'm reading some smart people's outlooks and some macro analysts, and we're talking about some massive, hey, the market could be down to, 20, 30, 40% corrections. And then the market could be up 20, 30, 40% to the upside. I don't know if that's lazy or that's just how indecisive and how uncertain everybody is. Meanwhile, the market climbs the wall of worry. There's an in-between that's going to be the normal. And, it's like, I just can't overcommit to anything. I'm not super bullish. I'm not super bearish. Being a super bear is honestly stupid. If you don't believe me, you'll be right once in an outlier event, and then you'll spend years trying to get that money back and try to be like, that was the best trade I ever took. I'm going to try to do it over and over again. And you will just get crushed with the years and years and years of the market just stays bullish. So you have to just, I don't know, just get over your ego and just trade what you see. There's a good time to be in and participate. There's a time to stay out. Trade size is what's going to help you survive. And I say this a lot, like the markets will give us so much opportunity. It really will. But if you are overcommitted and over leveraged at the top and this market has a cleansing in any way, shape, or form, that is when traders stop trading because they don't know what to do when the market is down 20, 30, 40, 50%. When a stock is down 50, 60, 70, 80%, they don't know how to come back from that stuff. Okay. So it's not about being overcommitted to anything. I get that you want to have like conviction, you want to believe in what you're doing, but you got to have I like to trade with options, especially because I have like a plan A and then a backup plan, another backup plan. I can always kind of repair my positions. I can kind of fight the market a little bit with some room for error. Here's an example, and I'll let you go. So I talked about Alcoa earlier for some aluminum. This stock has done really, really well for me, and I've been holding this thing for the last couple of years. Um, Marked out a bottom. I've been long in this thing since the low 20s. It's now starting to show signs of breaking to the upside. So I've been waiting patiently to get back to my highs around $45. It's there and it's going through it. So if this is a measured move going from low to high, I just stacked another move on top of here and I will stack another move on top of here. So my target on Alcoa, now that we've broken this level, is if we can go, let's say this is going to be a swing in the market. If we pull back, I'm looking for higher highs and higher lows. Okay. If we hit, another symmetry, that's going to be around $65 to $70. If we get back up, look left on your chart, back into the high 90s, I'd love to take some profit up here. Bought this thing in the low 20s. I'm adding to it, by the way. Like I'm adding here. I bought some more shares at $50. I'm going to buy more at 41. I'm going to buy more at like 35 and more at 23. I'm going to dollar cost average. I think this is a good enough stock now that above these highs, if we make higher lows and higher highs, I will start adding more to it. If we have a big fat pullback and kind of swing trade, I will scale back in. But I'm looking to see if my ultimate price target is going to be either 70 or 90 plus. So, what am I committing to this trade? About 2 to 3% of my portfolio. So even if I am dead wrong, I don't think the stock is going to go to zero. And so if it's 2 to 3% that I'm in a drawdown and I'm dead wrong, I can still survive that, right? But if you're all in the S&P or all in the NASDAQ or all in Tesla or all in anything, all in Bitcoin, it's hard to stomach something like this, right? I mean, look, I had a great year in 2025 and Bitcoin made me $0, which is really freaking sad because at one point this was up like 25 to 30% for the year and I had way more profit overall in the portfolio. I've since lost about 3.5% of profits, but Bitcoin is down 30%, and I'm down about 1.5 to 2% overall with my exposure in Bitcoin. So it's something I can manage. And since we have been on a decline, I've been on a premium selling spree. I've been selling covered calls. I've been trying to repair some of my break-even positions to try to make sure it doesn't sting too badly if this does get worse. This could be the ultimate kind of cleanse of crypto. And I'm curious, like, does it need to get rid of the altcoin stuff? Do we need to put, give Michael Saylor a lesson in financial engineering that you can't just, I don't know, you just can't sell debt on something that you promise is going to go higher when it doesn't, or it doesn't, right? So I have no idea, but there's clearly a lot of pain going on, and I think that crypto money is rotating out of crypto and into other stuff. I think that Bitcoin, crossing a 1 to 2, it was up to $2 trillion market cap, and now it's down to 174. Either this is the maturing phase where we start to then accumulate down here and get back to all-time highs, or there's going to be some severe damage done. You're going to have a pretty large exodus outside of crypto. We might be dealing with a 40, 50% correction in Bitcoin, but can we still survive that and go back to all-time highs? I think yes. It's just I don't want to be all in on Bitcoin. I would not want to lose half of my wealth in Bitcoin because the market decided just to, sell off a little bit. So that being said, MicroStrategy is down to 156. I'm watching that closely. I do have some exposure. I'm repairing some trades, but I think it's going to be something you have to ride it out. Like I know that MicroStrategy with some of the debt obligations they have has about a 21-month cash runway. And so as long as Bitcoin prices stabilize, And I know that it could be a very contentious trade. It could be very painful for MicroStrategy. It could be very painful for Michael Saylor. But if he can weather the storm and we can keep kind of the optimism in Bitcoin, maybe not so much in other stocks, maybe the grifting and the ICOs and all the crap that's been going on since COVID. Just maybe Bitcoin is just kind of going to mature as like the S&P 500 of crypto, maybe. So I'm still like optimistic. There's a time and a place. There's an investment story around Bitcoin, which I'm a part of. I like it, but I'm certainly not all in. So it is a trade. And the nice thing is premiums are quite high. You can get a lot of credit on IBIT for going out, 3 months, 6 months, 12 months. And I'm willing to take on some of that trade. I'm willing to sacrifice some of the upside as well. If we do return to all-time highs, I'm going to get a portion of that, not all of it, because I've been selling premium to, reduce some of the volatility and the risk that I've had to the downside. So anyway, just one of the many things in 2026. It's like, well, we've had gold at all-time highs, silver all-time highs, S&P at all-time highs, NASDAQ all-time highs. The market's running hot. We've got this great narrative, blah, 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 blah. And somehow Bitcoin is this like absolute disconnect. And there's still liquidity to come back in the system. So it's been disconnected from the NASDAQ. I just think there's something bigger at play here that has to kind of flush out all the, whether it's the bad actors, whether it's the leverage, it's just trying to get them out of the system. And once they're done and cleansed, you'll have some whales left in that are going to kind of build institutionally, and we'll see what this ends up becoming. Because at the end of the day, what does it still represent? It represents a play and a levered play and a hedge basically against the fiat system. So I think that's where your asymmetry is, what's the worst that can happen to Bitcoin? We go from 86 down to 0. What's the best that can happen? We go up to 1 million plus, and we're talking a 10x return. So if I did a 1% allocation and I lost 1% of my account, and this goes to 0 versus that 1% can literally become 10% of my portfolio, I think that asymmetry is still a great trade. And that's how I've looked at Bitcoin literally since I started trading it back in 2017. So, all right, I'll let it go from there. Thank you for watching. This has been about 46 minutes. Consider this one, big indecision for 2026. It doesn't mean that I don't have a plan. It just means that I am clean slate. You got to start over, start fresh. Think about what the market is going to give us. Let the market show its, like, kind of let the market give us its hand, right? Show us its cards, give us a little bit more insight, and then we align our probabilities and see what looks good. There will be big winners in 2026. There are probably going to be massive losers in 2026. I think what has been working might be a rotation away from it to other things. So I am not a passive investor in 2026. I'm going to be extremely active, very active with risk management, very active with good opportunities, and probably horizons anywhere between, a day at a time, a week or two at a time to a couple of months, but trying to keep everything pretty much contained. And then big picture is just lots of room for error and be opportunistic with having some cash on the sidelines. Okay. I don't think I took a breath for 47 minutes. So I just set a new world record. Anyway, just kidding. Hey, if you like this content or more, check it out. Be a part of my YouTube channel, be a part of my Telegram. I'm live every single day in my sessions. The daily profit plan I run live for any trader that's welcome to join. I talk the markets. I've got a service that I run with it that's sprinkled in, but I can touch on all of my courses and things like that. So, this is what I do on a daily basis. The services I highlight are all in here. So these are all different courses, alerts, and education that I have available. All you have to do is hit me up. I've got a Discord. I've got Telegram. You can join me live anytime and ask me questions live. And I've been doing this stuff for 12 years education-wise. I've been trading the markets for over 25 years. I'm here to help. I think that even if the market is generous to the upside, that's great. We've been gifted an incredible bull market for the last certainly the last 5 years, let alone the last 20 years after some nasty corrections. But I'm just as curious as you are. What is 26 going to give us? What is 2026 going to give us? So we'll figure it out. All right. Thanks, everybody. Let's have a good week. If I see something interesting, I will post another video. Hit me up live in some sessions or send some messages and comments. But I appreciate if you want to like the video and subscribe to my YouTube channel. And anytime I go live, you'll be noticed or notified. Okay. Take care. Talk.